Hi, in this video we're going to be talking about the stock turnover ratio, which is part of a number of financial ratios you can use to assess either your business's financial performance or the financial performance of another company, such as a competitor or even a company that you're considering investing in. So the stock turnover figure is calculated using the following formula. So you take the cost of sales or cost of goods sold and then divide it by the average stock. What you might find if you're looking around the internet is that some formulas call for the closing stock or closing inventory or ending inventory, depending on the terminology you're using, rather than the average stock. In this example we're going to be using the average stock calculation. So where do you get that information? So the cost of sales or cost of goods sold will be on the income statement or the profit and loss accounts, depending on the terminology that you're using. The average inventory, which is, as I said, or sometimes the ending inventory, will be on a balance sheet. It is either the opening stock adding plus the closing stock, so adding those two figures together, then dividing by 2 to come up with the average inventory or average stock, or if you are using the ending inventory figure, it's clearly just the closing stock. So what is it? So basically this ratio tells you exactly how many times your stock turns over, or your inventory turns over each year. So it might be that you're just looking at a particular product or a particular brand, in which case you'd be focusing on the turnover of that specific product line. Or it could be you could be applying this to your company's stock as a whole, in which case it would give you an idea of how much you're selling your stock per year across the whole company. So primarily this is a really good indicator for retailers or firms that actually sell physical things, rather than a company which is just offering a service who wouldn't necessarily be keeping anything in stock. So what can it mean? Well, in general, the bigger the number, the more efficient a firm is. So it's bringing in things, it's selling them really quickly, it's turning over a lot of stock, and obviously generating a lot of cash very quickly. So if it is quite low, generally that might suggest that you're not selling stock quick enough, which could suggest there's either too much stock. So for example, if you're bringing things in, putting them in your warehouse and you're not selling them, potentially you might have a problem there with your marketing or your sales functions not selling those things quickly enough. And what that might mean is you've got too much cash tied up in dead stock. So you've essentially invested in something, you're not selling it quickly enough, and therefore your cash is almost dead. It's inefficient, it's not being used. And potentially if you've got too much of that, then you could have a lot of money tied up in that cash, and that's obviously clearly not a good position to be in. However, it really depends on the type of product and also the market that you're in. So for example, if we go back to what I said on the first point, if you're selling lots of it and turning it over really quickly, that could be really good. And if you think about an example where that may be the case, you might consider a supermarket. So they could have a delivery, say on a Monday morning, that gets put on the shelf on Monday lunchtime, and they could have sold that particular thing by the afternoon. So in that case, you're going to be expecting quite a high level of stock turnover. Whereas, for example, if you're looking at industrial machinery, for example, you may only sell 2 or 3 of those particular machines a year, in which case you're not going to be expecting to see a really high stock turnover. Whereas it may be that you're actually going to be having quite a high sales price with those larger items, big ticket items, in which case it doesn't really matter if you're turning over a lower number per year, because you've actually got quite a high profit margin. Whereas if you're a retailer, say a supermarket, and you're only making a few pence per sale, you're really going to be looking at wanting a bigger turnover. So really it depends on the market that you're trading in, and also the type of business you are, as to whether or not you'd be expecting to see a larger or smaller stock turnover figure. Really what you want to be looking at is putting the data into a series, so you can identify trends over a number of years. If you're just looking at stock turnover figures of one-off year, it doesn't really tell you much at all, whereas if you're looking at it over a trend, you can really identify whether or not you're having a good year or a bad year, or whether things are improving or getting worse. And it's also really useful to kind of take your figures and then compare them to the figures of a competitor, because then it really gives you an idea of how efficient you are in comparison to a competitor. So we talked earlier about how a lower figure might be expected in a certain type of market, but if you can then compare that to your competitors who are selling a similar product to yours, or exactly the same product, you can really see whether or not your figures are low or high in comparison, and then you can start to do something about it if it turns out that you are performing worse. So we'll just have a look at a quick example. So we've taken a series of data over a number of years. We've got the cost of goods sold, we've got the opening stock and closing stock, and then we've got the stock turnover per year. So what you'd do is you'd calculate this figure and this figure, so you'd add these two up, divide them by 2, and then you divide the cost of goods sold and the average stock figure to give you your stock turnover per year. So you can see I've made up some numbers, and I've done this over a number of years, and with this particular business you can see that they're doing quite well. 2012, things didn't go too well in 2013, and things are going back up in 2014, but on the whole it's average, so you could say that there's not really been any particular improvement or downturn in the way they're performing in terms of their stock turnover per year. What you can see though is the cost of goods sold has either gone up, it has gone up in this case, so what you might expect to see is an increase in overall company turnover or profitability, although it could be that although the cost of goods sold has gone up, they're not actually selling more, it's just the actual physical cost of buying those goods has gone up. So what this really gives you an idea of is just how well you're performing on stock, but what it doesn't really tell you is how well the overall company is performing, and really what you want to be doing is using this financial ratio in conjunction with a number of financial ratios to really give you an idea of how the business is performing overall, because on its own it doesn't really tell you too much about how the company is performing, although it does give you an indication of how it's doing in terms of turnover stock. So that's it, that's the stock turnover. What we're looking at next is how you can use that stock turnover figure and then putting it into an actual number of days, which really gives you an idea of how quickly you turn that over in actual physical number of days rather than just a number per year. And then we'll be looking at some of the other financial ratios as well in this series of videos, so make sure you subscribe to the YouTube channel. If you've got any questions about this ratio or any of the other ratios, please ask in the comment section. I'd love to answer them, and I'll see you next time.